Good afternoon, everyone. Thank you for joining us again, those who are returning. And for those who are just coming for the first time, welcome. We're going to continue the industry briefing, and in this session, we're going to um, have a focused discussion on the legislation for credit unions. So we'll start off with some introductory remarks by Governor Roll, and then we will continue with our Deputy Legal Counsel, Fandira Carey, who will walk us through her presentation. That will be followed by a question and answer period as before. We will have an opportunity for persons in attendance in person to ask their question at the podium, at the mic and at the center of the room, and then we will also be taking note of the questions that are coming up on Zoom. So again, thank you and welcome.
Thank you. Again, good afternoon. I recognize some faces from this morning, and I'm glad that you've joined us for the afternoon session. As I mentioned earlier, we at the central bank we've spent some time putting together a collection of reform-focused initiatives targeting the regulation and oversight of our supervised financial institutions. And so that includes the international and domestic banks and trust companies, credit unions, and the money services firms. So some of the reforms, and so this afternoon we are going to have a presentation of the proposed reforms for the credit union sector. And I must say that in getting to this point, we've already had some consultation at the level of the League for the Credit Union Sector. And so this will be an opportunity, not just today, but subsequent to today, to reveal the progress that is made in between the initial drafting and the feedback that we've received on the proposed reform to the credit union sector. But the credit union sector is also impacted by the general reforms to the regulatory framework, which focus on the Bahamian financial stability framework and crisis resolution in its various forms, including the extent to which the deposit insurance is factored in that space, and the safeguards and arrangements that are in place so that the DIC can have a role in terms of how we manage the resolution process for financial institutions and credit unions. I think in terms of specifics for the credit union sector, the Credit Union Act or legislation, cooperative credit unions legislation, is up for reforms, and those reforms will, for the most part, target a range of prudential and governance related issues. Some of the governance issues touch upon the risk management framework that we are advocating for credit union sector, really deepening and enhancing that process. What is also important is the way the central bank as regulators and supervisors interact with the sector. There are proposed reforms that would make that process more direct in terms of the process that the central bank goes through when it's dealing with credit unions from an intervention point of view, to bring it closer in line to the way that process rolls out for other supervised entities. So that's very important. I know we've had, in some cases, some very interesting conversation on that. We're also working with the credit union sector in terms of how the process of senior management appointment, as well as the constitution of the boards, the the consultative arrangement that would be necessary insofar as the central bank is concerned in terms of the persons who are selected and elected to those roles. So I think that too will be a very important one of the reforms that are ahead of us. So this afternoon, we are going to be taken through the highlights of the draft legislative proposals, and we expect that we will get some feedback. But there is a consultation period that goes until the end of October. So we're also anticipating that there will be written submissions. We've gotten good written submission already at the cooperatives level, but this is also an opportunity for those who are members and otherwise affiliated with credit union to also feel free to weigh in because they may not have seen the work that we've done up to this point. So once we have all of that input, it is expected that after the end of October, there would be an internal review by the central bank of the input. And from a transparency point of view, we will typically publish the submissions along with the central bank responses indicating, how or whether those influence any adjustments to the draft proposal. So having said that, we look forward to the exchange today, and we encourage persons who might even be watching either the live stream or the recording of this event to still feel free to submit questions based upon what they observe over the course of the presentation. So having said that, I will turn things over to the persons from the central bank's legal unit. They will introduce themselves and they will take you through the draft proposals. But again, we look forward to the feedback and any questions or queries that you might have. Thank you.
Thank you, Governor. Good afternoon, everyone. To those present as well as those joining us virtually this afternoon. Your presence is much appreciated as the central bank values your partnership and the partnership that we have with our stakeholders. I am Vandira Carey, the Deputy Legal Counsel here at the Central Bank. And as most of you may know, on October 2nd of this year, the Central Bank released a compendium of legislation for public consultation. And that would have included the Bahamas Co-operative Credit Union Act, Amendment Bill rather, and the Bahamas Co-operative Credit Union Regulations. As Governor has noted, this segment focuses on the legislative reforms proposed to these pieces of legislation with an aim to strengthening the credit union sector and the country's financial system at large. Okay. I will cover the more substantial amendments as we would not have sufficient time to capture all of the proposed amendments today, but I can assure you that the consultation paper is detailed and so is the draft bill that would capture every proposed amendment there. I would also ask that you reserve your questions for the conclusion of the presentation. So firstly, we will have a look at the historic timeline. As a way of background, the central bank assumed supervisory authority over the credit union sector in 2015, and this was done pursuant to the Bahamas Cooperative Credit Union Act that was also established in 2015. Since that period, the Act and regulations have remained in place for, you might as well say, a decade without any legislative reform. However, in 2020, the Protection of Depositors Act, that was amended, and it was able to capture credit unions and bring them under the remit of the Deposit Insurance Corporation during that time. But apart from this, no further legislative changes were made until now, and we are now proposing, by way of amendments, the Bahamas Cooperative Credit Union Amendment Act 2025. As indicated, there's been no legislative changes, and this has brought about many constraints for the central bank in the execution of the supervisory role that we have. And in other cases, there was quite a number of legislative gaps, resulting in the lack of resolution and good governance provisions. And if I may be more specific, the lack of authority to take proactive measures to prevent the failure of a credit union was also at stake. The International Monetary Fund, the IMF, better known as, also reviewed the Credit Union Act and provided recommendations for us. And this would have included the need for the establishment of a resolution regime for failing credit unions, which will include a specified set of triggers for entry into resolution and authorization for the central bank to exercise resolution powers in respect of a failing credit union. However, the central bank also proposes to place these crisis management provisions in the Central Bank of the Bahamas Act, which will capture and relate to credit union sector as well as all of our other licensees. So these resolution amendments have also been proposed in the bill, more specifically. Okay, we will look now at the reform of the Act itself. In an effort to modernize and provide flexibility to the sector in terms of how meetings are carried out, the bank proposes an innovative provision that allows for AGMs, annual general meetings, as well as special AGMs to be held either in a hybrid setting or virtually. Now, this may have been the case already for some credit unions, but it needs to be regulated. So that's the reason for us formalizing it here. So therefore, in Clause 2 of the bill, you will see the introduction of terms relative to virtual meetings that may be held by credit unions. And we will discuss those provisions later on down in the presentation. Other terms have also been removed and replaced, such as the term order of request that you may be familiar with, and that will be replaced by the term directive. So this will bring about uniformity across all of the legislation that is administered by the central bank. The bank also proposes the introduction of the term audit committee. This is a new board committee, and we will also discuss that later on in the presentation. Thirdly, futile terms that add no value have been removed from the Act, such as the term minors. The age of membership is already established as any person over the age of 15. Therefore, the term minor doesn't add any value nor take away. So the term minors will be removed. Okay. You will also note in the bill that there are enhancements made to many of the provisions. An example of one is Clause 6, which amends Section 14.5 to add an additional 5 subsections outlining conditions by which the registration of a credit union may be canceled. And you'll see here on the slide that some of those include if it appears likely or becomes, if a credit union becomes unable to meet its obligations as they fall due, or if a credit union is unlikely to meet the demands of depositors of the cooperative credit union, or if its continuation in business is likely to involve a loss to the members of the cooperative credit union or to the creditors, or in the case of a credit union that is placed under statutory administration. So that would be some of the means by which there can be suspension or cancellation of a license. Facilitation of AGMs. Now, the bill proposes in Clause 8 to amend Section 20, which addresses the facilitation of these types of meetings. And the provision is more prescriptive. It outlines means by which the meetings can take place. So it requires more and better particulars to be included in the notice, for example. So the notice should specify the purpose of the meeting, the type of meeting it is, whether it's in person or hybrid. You should include the virtual link for members attending in that fashion, and just describe whether it's going to be fully virtual or hybrid, etc. Further, it will also advise credit unions not to hold a general meeting virtually unless it is satisfied that every member is able to attend and fully participate in the meeting held in that fashion. Also, you would see that there's now a requirement for the central bank to be provided with notice of an AGM within 7 days prior to the date of the meeting. And in continuation, the new term that I referred to earlier, introduction of virtual meetings. The bank is pleased to introduce this new and innovative measure to provide more flexibility to the means by which these meetings can be held. It is also noted that AGMs, like I said, can now be held virtually, and it requires for members to be considered present if they are attending in that fashion. Also, if there are any documents that will be tabled at the in-person meeting, those should also be provided ahead of time to members attending virtually. It is expected that each attendee is able to participate in the conduct of the business of the cooperative credit union meeting, including the voting process. Each attendee is to be seen and heard, or to be heard by the other attendees in the room. So that should be properly facilitated. Also, there should be effective communication with the chairman or other officers and other attendees during the meeting as well. Communication between an attendee and the chairman or other officers. If there's any failure of electronic communication systems or computer system enabling virtual participation, that would either deprive the attendees, of the ability to participate, or identify any other attendees, or be identified by the others, would result in an offense. Clause 12 of the Act proposes changes or enhancements, I should say, to the dormant account framework. So there have been some amendments to the dormant account framework. And as you would see, for starters, the current provision, as you know, the dormant period is 5 years. That is now being revised to reflect 7 years. Also, there are new terms being introduced, the term dormant and transactions. Okay, so in a nutshell, the proposed definition of dormant account would reflect a deposit account or other facility at a cooperative credit union where the members has not initiated any transaction for a period of 7 years with respect to a deposit account or any other facility of the member held with the credit union. And the term transaction is defined as an action initiated by a member in person or by electronic or other non-physical means in respect of a deposit account or other facility that such member has with a cooperative credit union and includes a deposit, withdrawal, exchange, or transfer of funds in any currency denomination, whether in cash, check, payment order, or other instrument. Also, a communication acknowledgement, request, or instruction where evidence in writing and signed by the member, or a contemporaneous record of the member's verbal instruction prepared by the cooperative credit union. So the bill proposes also the potential liquidation of security boxes held by members, which may contain precious metals, gemstones, securities. Those may also be liquidated as well. Okay, so this is just a recap of what we just covered. The period has changed and the introduction of the terms. And then instructive provisions have also been implemented for the handling of dormancy and inactivity after a period of time. So those are itemized in the draft bill. Directorship. Okay, so fundamentally, we know that directors have a duty to generally act in good faith and to uphold good corporate governance. Therefore, we believe that the duties of a director are integral to the success of and compliance of the credit union. In this regard, the bill is introducing a few provisions to fulfill these measures. Firstly, the pre-approval of directors. A member who is interested in participating in election to the board must firstly be pre-approved before participating in the electoral process. This also refers to incidents where a vacancy on the board may arise. The bank should be notified, and the same process should be carried out before that position can in fact be filled. Secondly, a director may be removed, of course, by membership, so that provision remains. It's been slightly enhanced. And secondly, a director may also be removed now by the central bank. So wherever he fails to discharge his duties effectively, or is involved in financial indiscipline or mismanagement, or contravenes the act in any way, any of those instances, he may be removed by members by resolution. The bank, like I said, will also be able to issue notice to a sitting director for his removal as well. There's a criteria outlined in the bill by which that can be facilitated. So the bank would then make a decision to confirm, vary, or revoke the notice of removal after the director is given an opportunity to be heard. The power to make directives. Okay, so this new provision provides more ways by which the bank can issue a directive. These directives are evoked in several instances, which include where the central bank is satisfied that a cooperative credit union has failed to comply with a condition imposed or has failed to carry out measures required by the central bank, or it has breached any provision under this act or any other written law, direction of the central bank, or bylaw or written policy of the cooperative credit union. Also, if it is acted or is likely to act in a manner that amounts to an unsafe or unsound practice, or it no longer possesses or is not maintaining a position to maintain adequate capital resources, or it no longer provides security for funds entrusted to it. So any of those scenarios will invoke the power to make a directive. The resolution framework. In response to the need for reform, we have outlined a list of general areas by which the resolution framework would be evoked. Firstly, the appointment of a statutory administrator. This is a new provision under the bill, you would see. And the process for the appointment of a statutory administrator is achieved without court intervention and is able to be actioned whenever the trigger arises. This will allow a prompt facilitation of the statutory administration process to salvage the assets of an at-risk or failing credit union as much as possible. The bill also affords the statutory administrator the accompanying powers that it needs to take control of a credit union and fully manage the day-to-day operations of the credit union. This also vests the statutory administrator with the same powers that a director would have. Management control functions, responsibilities are all afforded under this provision of the Act or draft bill. There have also been some enhancements to the liquidation provisions, as you would note in the bill. The liquidator is also appointed by the central bank. Some of the powers include the right of the liquidator to act as the sole legal representative of the cooperative credit union, assuming all rights and powers of the directors and officers responsible for the management of the credit union. This includes the unfettered access to and control over all books and records, the offices, and assets of the credit union as well. Provisions are being imposed to prevent or to penalize any person for willfully obstructing the exercise of the liquidator's functions. It is also worth noting that provisions specific to measures that can be taken to stabilize a failing credit union will be placed under the Central Bank of the Bahamas Act. Under the current regime, the appellate body, as you know, it is referred to as the Registered Cooperative Credit Unions Appeals Tribunal. We are now proposing that title be changed to the Bahamas Cooperative Credit Unions Appeals Panel, and this body would now be Right, so the league will now be responsible for the appointment of the members to this tribunal. Previously, it was the minister who appointed the members to the tribunal. Clause 28 of the bill seeks to repeal Section 92 of the Principal Act and to replace the section with new provisions which would mandate the Cooperative Credit Union League to facilitate the establishment of this appeals panel. And it would also be responsible for outlining the qualifications for members of the appeals panel. Clause 29 of the draft bill seeks to introduce a new section as well, which mandates the members of the appeals panel to adhere to a code of conduct established by the league. Clause 30 would also outline the process by which the settlement of disputes among members, past members, cooperative credit union and directors, or credit union and credit union would be carried out. However, any appeal that lies with the central bank ought to be brought before the Supreme Court. Okay, we're at the board committee segment, and the bill proposes to restructure some of the committees. Well, restructure in a sense that they will be renamed as board committees. So the nomination committee, for example, used to comprise members solely, but they will now be composed by directors. So after further consideration, the bank is provisionally minded to maintain the supervisory committee as is, albeit the structure is no longer consistent with international standards and best practices. The central bank will still seek to strengthen board-level operations by establishing a board-appointed audit committee. As conceived in the existing credit union legislation, the supervisory committee is an oversight body with reporting responsibilities to the shareholders. The central bank will also develop regulations to enhance the effectiveness of their role as well. Clause 14 of the draft bill proposes to repeal and replace Section 48 of the Principal Act in order to reform several of the subcommittees, converting them, as I said, to board committees. So the credit committee will now comprise 4 directors. 1 to 2 of them should have experience in credit risk and managing credit risk. And the audit committee should comprise of 2 directors. 1 must be a financial expert, but not a member of the cooperative credit union, among other requirements. But I will note that he must also have recognized expertise in accounting or auditing. The apex body, now take a look at that. Sorry, here we are. The apex body, as we know, the apex body has been functioning in an advisory role, and the bank seeks to enhance the requirements of the apex body to provide more sectoral support and collaboration of the credit unions. This provision also outlines that the apex body should assist its credit unions by providing programs and services to strengthen the sector. And this should look like, we should see more technical advice being provided and shared services and training as that, how that, however that would look in practice, that should be carried out. Okay, and then just these few miscellaneous provisions I've placed here for our discussion as well. Firstly, the bill proposes in clause 46 to remove the exemption of value added tax, the exemption that's been lifted from the bill. The proposed amendment to Regulation 3. Before we get to the regulations. So we have, like I said, removed the valued added tax exemptions for credit unions to provide fairness across the sectors. Also, the fitness and proprietary provisions have also been removed from the regulations in place into the act, the bill, the proposed bill. You would see the criteria there, so it would no longer be placed under the regulations as it is now. Another change is the registration fee increase, as you would note in the draft regulations. That has been expanded and increased because of times of change, and it's been a while since that has been reviewed, so we can discuss it after. It is also proposed that Regulation 19 of the principal regulations, which sets out the fitness and proprietary provisions, as I said, those are now under the Act. Okay. And last but not least, there's been the removal of the restrictions from credit unions, allowing for more flexibility to offer personal loans for longer periods of time and for loans to be amortized over the tenure of the loan rather than it presently is, which is 84 months. Yeah. Okay, so that brings us to the conclusion of this presentation.
I think there's some other clarification that are important. The first one of them is that there is nothing in the proposed regulatory reform that is a response to any single current or past incident in the credit union sector. Um, we've had some credit unions, very small, even from startup, that were liquidated. Yes, we learned from those, but they do not motivate what we're doing. What what is important to understand is that the difference between a lot of the self-regulatory uh, industry code-based principles that the World Council of Credit Union espouses versus the risk-based prudential uh, framework, which is complementary to the financial performance-driven metrics. But the risk-based framework, which recognizes a lot more um, the environment in which credit union or financial cooperatives operate. It also recognizes that from a supervisory perspective, when you're dealing with resolution, that and you're dealing with how you manage credit unions on a risk basis, on a continuous basis, that the way the regulator interacts with financial cooperatives needs to be look similar to the way the regulator would interact with other financial institutions. And so when we talk about directives and requirements and expectations, it's really just speaking to when something needs to be addressed within the financial institution, you know, the the weight or regulatory force that is behind the communication that comes from the regulator looks different than just a moral suasion driven um, event. And then also, to the extent that it is risk based and it is crisis management based, preemption is very important. And so, for every single financial institution, we say, think about how you manage yourself if you encounter an unforeseen crisis. And in this case, we say the crisis could go all the way up to the level where you're likely to fold up and close shop. How do you think about that on paper in terms of how you would resolve that? How do you think about on paper how you might turn it around and get your shareholders, if need be, to recapitalize your operation? Or how do you think about how your operation may be merged into some other operation? So it's thinking about all of those things beforehand so that when you are required to act, you can act, but also to allow you to see where there may be gaps in the way you may be set up. So, so from that point of view, there are some very important principles coming across. But I can say that insofar as prudential and risk-based supervision is concerned, we will still have a gap that we need to close for the credit union sector, and I think that's going to grow with experience. And when I say we have a gap, the gap is also in terms of what is written in terms of the regulations and standards. And so we are going to have to prepare that, over subsequent years, we start to look at what the risk-based principles are and how they can continue to expand alongside the Pearl standards, etc., and get the credit union sector moving in that direction. There's one positive that I think we probably didn't speak too much to, but also that we heard what the sector was saying in terms of the cap that they face on the maturity profile of lending. So that is taken out of the existing legislation, but it still then points back to us because it still means that we can do that because we're comfortable when we look at all the potential baselines or benchmarks, we'll know when there's increasing risk or manageable risk, that might be the case, that we can address. So that is very important. And also at the the governance level, regulators do not go out there, advertise, and handpick um, who manage financial institutions, whether it's at the board level or at the management level. Those are put forward by the institutions, and all the regulators' role is to see whether the individuals are fit and proper. And if they are competing candidates for a role, that is still a decision that is made at the financial cooperative or the financial institution level. So that is very important to understand in the context of the reform. And the other reform is, insofar as risk management is concerned, recognizing that the supervisory committee and its watchdog oversight and accountability to the membership, we can find ways to even empower that more. But some of the reforms are also saying now that the board is also now more directly responsible and accountable to the regulator for risk management. And hence, when you look at the way the audit committee is structured, it is to make certain that the board delivers on it. And I think a part of the dialogue is going to be how, in strengthening the audit committee, do you allow now the supervisory committee also to have a better dynamics? Because a part of what we observe is making certain that the transparency is there, so the supervisory committee sees and has access to what it needs to have access to, so that it can fully deliver on its functions. So those are very important. The dormant account issue, again, that's really just aligning the framework with the way the dormant framework exists elsewhere in the financial system, up until the level where, after I think 17 years, those claims expire and they typically are escheated to the government. There's a lot more reforms to go on in that space, because what we want to do as well is put in place in the Bahamas a framework where people can actually more effectively query what dormant assets exist that they may be entitled to under some estate, but they have to still demonstrate in that query process that they have a legitimate claim to the assets, but at least make it so that people can make the queries and determine what exists. So that's the reform, I think, that's ahead of us. And to the extent that dormant deposit or deposit-like funds exist anywhere in the Bahamian system, the credit unions would also be covered in that process. So that's something that is also important to bear in mind in terms of the reform. And there are some other provisions like those that, and even when we think about resolution, I think we've had a very good experience already for very small financial cooperatives in terms of the collaboration between the central bank and the league. When you start to look beyond that in terms of entities that may be systemically important to the credit union sector in the future, if you have to deal with a resolution process, it will look different, because even the financial resourcing implication will be different. But still, then yes, you might have to have that collaborative arrangement. But what this reform framework is sketching really is anticipating that, financial stability, crisis management, prudential supervision, risk-based systems, some of the issues that the framework anticipates, we've not encountered yet, but we have to prepare now so that we can deal with them, and in many cases preempt them, because preemptive is the ideal for us. So from that point of view, I think it's going to be very important to get the sort of feedback. But everyone to understand, we're building a stronger system. We're not reacting to some past experience, so that people don't really think about it just like that. We have to be preemptive.
In reading the amendments to the legislation, particularly regarding the retention of the supervisory committee and the establishment of the audit committee, there seems to be a duplication of responsibilities. I just want to clarify if that is true or not, And if it is true, what is the rationale behind having both parties there?
Thank you for your question. Firstly, the bill should show that the supervisory committee's role will remain in place. We have not disturbed any of the provisions that relate to the functions and role of the supervisory committee. However, the audit committee, like I said, is a board committee, and that the role and functions of the audit committee is to ensure that there's an accountability body in place for the board. So the audit committee reports to it is a board committee, so it's not the same. It doesn't carry on the same as the supervisory role, which is more like a watchdog for the sector. Right. So it's more like a watchdog for the sector, meaning that it acts on behalf of the membership, keeping the management accountable, whereas the audit committee is a board committee that ensures that the board is functioning as it should.
Okay, you also mentioned that regulations are expected to be released regarding the function of the supervisory committee. When is that expected to happen?
Sorry,
You said you were releasing regulations to clarify the function of the supervisory committee, particularly when you have an internal audit function that's working full time.
Okay.
What exactly is that role supposed to be?
Those regulations will be to more or less refine the role of the supervisory committee, because what does the supervisory committee do now? The supervisory committee now is there as a tier or a body that's responsible for keeping the membership informed, not so much to dictate to the board or to dictate to the board. They more or less meet with the board. I believe quarterly it is. They meet with the board quarterly, and that is only to I don't have the legislation in front of me right now, but you may know better than me your reason for the supervisory's role for meeting with the board on a quarterly basis, but they do not dictate to the board. The supervisory's role is not to dictate to the board. It's just to review the books, and that's it. Not even the records, but more so the books.
The concern
And then
is that
they offer an internal audit function in the event that there's only on an interim level. It's on an interim basis where there's no internal auditor. The supervisory committee would facilitate that process only for that interim period.
See, and that's the problem. The way the legislation is currently written, it seems to be open to interpretation. So as soon as you can close that gap and put in black and white exactly what they should and should not be doing.
It's there. It's there in Section 86. It's there. Yeah. Stacey, do you mind passing that for me, please?
But it's just a good point because
we can look at it.
even though in some of the cooperatives, if not all of them, by default, they've seen to it that the internal audit function with staff. The legislation said that they only picked up that slack if those who were responsible for it failed to do so. So now you have to
You
hold
can
that.
interpret it that way, but it doesn't specifically say that.
But you have to hold, you have to remove, you have to make that accountability clear up. Yeah, so that's very good.
So
very
we
good.
need the
Yes.
central bank to close that gap
Yes.
from the regulatory standpoint.
And that's a part of the task. Yeah.
Okay, and one more thing. You want to make the decision as far as approving directors to the board moving forward. Exactly at what point through the election process does the central bank plan to get involved?
Pre-election electoral process. So
Okay, so
before
when they're
before the
nominating
engagement, yes.
Okay.
Once the nomination occurs, those names should be submitted to the bank.
Okay. And can you give any kind of estimation on how long it would take to actually vet them and approve them moving forward to the election process?
Not quite, but I would say that it would be within a reasonable time period.
It's a similar process with the commercial banks. So once all documentation has been submitted, and the team is able to review those documents and don't have any further questions or require further documents, then the credit union would receive the feedback on whether this application that was submitted is successful or not.
I guess
But
what
is
I'm
there
more
a set
specifically
time?
Yeah,
how,
so the
how
time,
far ahead of the AGM should we
Uh-huh.
get them to you so we don't have any
Oh,
issues
that's what
going into
you're-
the AGM?
yeah, so before
We,
14 days?
we
Yeah.
Good.
All of that would be, yeah.
We definitely, considering that this is a process that we intend to put in place specifically for you, knowing what is expected, we would have to ensure that we accommodate, the time frames that you would need. So that would be something that we'd have to establish even as a service standard. So that's something that we would look to ensure.
Okay, so I don't know if you actually answered
Mm-hmm.
when is the regulations for the supervisory committee expected to be released?
those are underway, so
Okay.
we will advise
We
the public
need, yeah, we need
and
that gap to be closed. Thank you.
okay, thank you too.
Good evening. Ricardo King, Bahamas Law Enforcement. Thank you, Governor, and your team for this industry briefing. I have a concern with reference to the dormant accounts. The qualifying share account is what gives the member ownership in the credit union. We believe that as long as a member has the qualifying shares, his account can go dormant. His accounts cannot go dormant simply because the qualifying shares is not only about transactions. It's about voting. It's about the insurance coverage. It's about being nominated to run for the board. So it gives them ownership in the organization. All right. I see the Act speaks to deposit and any other facility. So I include the qualifying shares in any other facility. If there is a concern that these accounts may go dormant, and it may be taken into our revenue, we have a stopgap measure for that, and that is every member signs a beneficiary. So if the member does die, the beneficiary would get the money. It doesn't stay with the credit union. Mm-hmm. If the beneficiaries are not available, then the family is contacted to have the estate probated. So based on that, we would like some consideration to be given to how we address dormant account going forward.
Okay, I have a question as well. The qualifying share that you referred to, how are those held? Are they held within the deposit account collectively with the client's fund? How are they treated?
They're separate. They're in the balance
separate.
sheet. They're carried in the equity section of the balance sheet.
Right.
But-
So I don't know if this applies, but I will accede to my colleague. Maybe perhaps she can speak to that. I don't know if this provision quite applies to the shares, but maybe somebody else can.
It doesn't apply to the share.
I don't. Yes.
Okay. Right. But it is our contention, though, that if the member has the qualifying shares, then the accounts, all of his accounts, are still active. Yeah.
I think that's a very helpful piece of information because inevitably, dormant facilities are usually facilities where you even lose the interaction and engagement with the individual. So when we refine administratively what this looks like, it presumes that it is for all intents and purposes dormant. So we could also work on how we define dormancy if you have a very active process of managing, all of those. So that helps.
Okay. All right. The other point I wanted to address is capital adequacy. Now, I know it was not stressed in this. However, we have, with the credit union, where we address capital adequacy based on total asset. In my balance sheet that I could speak for, 30% of my balance sheet is cash equivalent investments, and those investments are in government registered stock. 66% of it is loans, 67%. There's a good portion of those loans that are cash secured or have sufficient security. I've been fortunate enough to have a good performance, not so much delinquency. So one of the things we would like the central bank to consider, one is the weighted average, or rated risk approach on capital, or to consider looking at our balance sheet and the depth of risk that it carries, and possibly adjust that 10% which is applied to total assets.
Okay. Karanda or Sharice?
I mean, this is something we started to look at previously, and it's something that we'll possibly consider. However, given the size of the credit unions, their balance sheet, like this, with respect to the smaller credit unions, it could place a strain on the balance sheet when you risk weight assets. You talk about loans, and typically when we look at the commercial bank's balance sheet, those loans are risk weighted at 100%. And the banks, in particular the domestic banks, their capital requirement is 17%. So you're looking from moving from 10% of total assets, which gives you a little bit more flexibility, to having that flat requirement of 17% that you aren't able to, well, the sector isn't able to achieve at this time, just looking at your balance sheet and what you have been reporting so far in terms of the gearing ratio, capital to total assets.
Okay. All right, so consideration then could be given to possibly looking at the level of risk in the balance sheet.
That's what we look at when we calculate the capital adequacy ratio. You look at your capital and over your risk-weighted assets times 100%. So we're looking at it. So cash would be risk-weighted at 0%. Loans, as I mentioned, 100%, depending on certain factors. You see what I'm saying? We're looking at each asset and risk-weighting it. And so those are going to be, the denominator is your risk-weighted assets, and the numerator is your capital.
Okay, but never mind the fact that a large
it's
portion.
something that you can look at now and see where you, as an institution, would fall, and then you could compare it to what we have in our capital adequacy regulations now, to see where you would fall and to see whether this would be in your best interest based on the size of your balance sheet.
Yes.
Because it's going to be a strain on your capital and obviously also on your lending, which is already strained.
Yes. But never mind the fact that a large portion of my deposits are being held against those loans.
It's still risk, yeah. That would still be considered in the risk weighting, but you would have to do that calculation yourself and see where you land, and see if what we are asking, for example, the banking sector, that 17%, they exceed that. They're holding way more than that, but they can afford to do that. Yeah.
Looking at the proportional size of the sector, so you want to make sure you're assessing the sector on a proportional basis. So if you're applying something such as the capital framework, that the sector can sustain that and it's not providing an unnecessary requirement to the entire sector. So while individually an institution may assess their capacity, and you're free to do that in accordance with the capital framework, the sector is what we're looking at in terms of how each institution will look at it on a proportional basis. So if you recall this morning, we defined small institutions, and of course the entire credit union sector would fall within that. And so even within that sector, there's some smaller entities. So you want to make sure that we are considering, from a supervisory point of view, the risk-based proportionality.
I would add to that, when we look at where the sector is now, even if we use a different framework, we would still make a distinction between just doing, the baseline assessment and what the target is, and being mindful of how you gravitate towards the target. So whether your suggestion is more advantageous or less advantageous relative to what you might have in the pearls ratios will matter less relative to whether we are now going to vary the target from what we initially assessed. So I think that's what's important. And in all these cases, we're realistic in terms of recognizing that if the target is different from what we assess, then we have to work towards it. And I think there are, even in the case when the credit union sector looks at what they want to see in terms of their lending environment and outcome, in many cases, you foresee an outcome that looks different than the present. So it'd be similar in terms of how you progress towards it, and not expecting, say, a 12-month or even in some cases a 24-month, deadline, depending on the issue. But at least it takes us a lot more, even what you're saying, to looking at things from a risk basis. And the risk basis does clean up a lot of the way one might be looking at things that we probably are not fully doing right now.
Okay, I take your point. But I'd like to say to Ms. Smith, though, is that the bank's balance sheet have a whole lot of other risky stuff besides loans. Credit union balance sheet, basically, it's only loans. So if you took 100% of my loan, my capital requirement would still only be about 7% thereabout.
Yeah. But you're similar, you're in the same space. So you're similar to the commercial banks where their largest asset component is loans. So with the commercial banks that are grouped with you, the domestic systemically important institutions, their balance sheet, the size is different, right? But the components are the same. Loans, they don't have a lot of investments, and you're looking at more trust companies and investment companies that would have investments and stuff. Yeah, as the largest asset component. So you're similar. You operate similar to the banks. You accept deposits. You give loans.
Yes.
Yeah.
And we hold deposits against you.
They do the same. And we factor all of this in. Yeah.
Yes. Okay. And the reason why I speak to that is because in a lot of cases, the 10% is basically where we are, many of the credit unions. So it's razor thin, in my opinion, for me to be able to really take any major risk in lending. So it kind of ties my hand. So that's the reason why I speak there. But I hear what you're saying.
Understood.
So I need to look for another way to address that.
Yeah, yeah.
And we are pushing everybody into stress testing. And so when you start stress testing based upon the risk on your balance sheet,
Yes.
we're going to see the capital come under different levels of threat.
Yeah.
Which
And then,
lead
yeah.
to different strategies and expectations.
Yes.
Right. And unlike the commercial banks who may have a parent company to rely on to inject capital, the credit unions would have to, revert to the membership to either increase equity shares or, so, yeah.
Okay. All right. My last point is a simple one. You indicate the appointment to various committees, and you speak to the qualifications, which is fine, but you also speak to experience. Would the central bank be at least giving some detail of what the experience that you're looking for? Would it be years? Would it be position? Would it be?
So that is covered in our fit and proper guidelines that was recently issued. The criteria, all of those, the criteria are outlined in those guidelines. So we speak to character, we speak to the financial position of the individual, experience, all of that.
And then the
I
legislation.
believe you're referring to the directorship
Yes.
Yeah.
in particular in terms of what expertise they should have.
Yeah,
Right.
because those,
And,
Right, so we-
those directors are members of
Are you
the
going to
committee.
require them to have years?
How many years of
of
experience?
experience to that extent? That is something that.
I believe we use the term recognized.
Total package, so, not any single individual is assumed to provide all the skills that the board needs. So at the end of the process, you're just making certain that other than the fit and properness of individuals and every other step, that the board has the right cross-section of skills. So it's not expected that everyone comes to the board with the same qualifications on paper, but that the board is constituted in such a way that it has the balance of skills that it needs for its business. So that would be, and so even in those cases, you know, we might say to you, well, we think you need someone on your board that understands technology risk. Now up to you to find that individual, or maybe depending on your line of operation, that maybe you need someone with some legal background. We don't handpick that individual, but then you can use that to know how you recruit to fill any vacancies that you have. So that's the way beyond fit and proper that the regulator starts to look at, you know, the makeup of the board.
Okay, thank you.
And I would add as well, we use terms like a recognized expert, or when we use terms like expert, that would speak to how learned the person would be as well.
Yes, good afternoon, all.
afternoon.
Governor, persons in their proper protocol being established. I'm Omar Neely. I'm from the Bahamas Law Enforcement Co-operative Credit Union as well. I wanted to say something with respect to the makeup of the board. We talked about the audit committee being a board committee, or having the audit committee come out of the board. Is that what we're moving into? We also mentioned the criteria or the experience that the central bank would want to pre-qualify persons who would be joining those boards. I wanted to put in the atmosphere the practice, and based on the 2015 Act, all of the committees that are set by the board, there are technocrats on those boards. If I could give you a clear guideline, we have board members are 7 members, and also on that, not a board member, but the manager also helps to guide that board. On the supervisory committee, they are guided also by the internal auditor. All of the committees that we have, board committees, let's say the HR committee, they will have someone who is a technical expert from that credit union, usually that serves as a part to assist in guiding that board, those directors. The whole idea, if I'm wrong, someone say to me, of corporate governance is that the board members themselves are not technocrats. They're, for the most part, laypersons who will take the advice, the policymakers, the board members, based on the advice of the management and the technocrats that exist in that entity. They will advise, they will represent the membership who are the owners. So the board is a small portion elected by the members to represent the members. They're not the attorneys, they're not the accountants, they're not the internal auditors, because, number one, first, don't forget this now, board members are volunteers. So when we look at the expertise and criteria that the central bank will require from certain boards, we have to remember that, hey, these people are not being paid for these positions. They are policymakers and they're being guided, ideally, by the technocrats that exist to do the same. So I just wanted to put that in the atmosphere so that we can all be on the same page on who these persons are leading these boards.
Mm-hmm. I understand that you want to maintain the member-driven ethos of the credit union. That's respected. However, the financial sector is becoming more complex, and it requires the more technical or adequate technical expertise. And that's something that we found is lacking in the credit union space. And so we just want to ensure that there's sufficient competency, and we want to achieve more sound decision making at that level. So in keeping with that, I'll also say that if you look at the makeup of those boards, you would see that we are only asking for one or two experts. So there's still a hybrid, there's still a fusion of the membership with technocrats. That's not being taken away. You may have members who are already technocrats. So there's no bar against those persons participating. So I hope that adds some value to what it is that we're proposing.
If I can add, I hear what you're saying, and I think just a matter of appropriate governance, I think we want to be sure that the directors nonetheless are directors, and they should be able to ensure that they're comfortable with what is being said to them. To the extent that you have a technocrat there, if you have another person who can speak that language, they understand that, and they could say whether they agree or disagree, as opposed to, if you have someone with that type level of expertise there, you have an even more sound basis for carrying out what is needed to be done. So I don't take away from, I guess the methodology that's currently being used, but I think we're just trying to strengthen what is happening in the governance of the sector, allowing for someone to be able to challenge what may be coming to them rather than just accepting it.
Certainly,
So I think that's the main reason for what.
I agree with what you're saying, and I certainly agree that there should be some criteria with which these board members have to stand to or to come up to. I just wanted to put that in the atmosphere, exactly how.
And I think that's fully appreciated. I think the point here is really
you wouldn't want a random person off the street sitting at the board. They can't understand what the manager has to say.
The central bank will again remember now we're saying that we would be looking to approve these persons too, right? So and there are certain guidelines that would be put in place. So I think at the end of the day, it's not to take away from, it's to add to. So we're trying to strengthen the governance, and to strengthen the governance, we want to put persons in place who can actually challenge what may be being given to them, and bring some stronger, strength.
If I can add one more comment with respect to the board committee, particularly the audit board committee. I want to put in the atmosphere once again the term separation of duties. When I'm a board member, when we sit at the board, we make decisions, reference the policies based on advice from the manager. I'll say I'm a relatively qualified person myself. I wouldn't toot my own horn today, but we don't make those policies in the presence of the supervisory committee. They're independent. So once you would have made that policy, and you'll see things start to unfold with respect to a new product or some risk or something that we did new, the supervisory committee, the internal audit function, the watchdogs, they will then review those things and say, Mr. Neely, you all ain't making no sense. You all need to do this, do that, do it, etc., based on our observation. When we have the auditor on the committee making the decision as well, it gives that person a little less of independence in terms of scrutinizing the decisions or the policies that are being made.
And maybe I'm misunderstanding what you're.
I'm making particular reference to the proposed audit committee
right, but I don't,
coming out of the board.
Right, but the audit committee, I think, as we're talking about, is not necessarily inclusive of an auditor.
I understand you.
Right. So the independence is that the person on the audit committee is independent of the management and the staff. That's the independence. That person is part of the board, and they're looking at it from a more, from a board level, the audit aspects of
so
it.
This person, these two persons, I think you mentioned two persons for the audit committee persons. Experts. Would they also sit on the board?
At least one, right? I don't know if both. Yep. Yes. And that's consistent. That exists.
Okay.
That exists now within organizations, audit committees of boards. That exists. That's not a new, a new, you know, a new
You can also,
committee.
you have a committee, board members must be on the committee.
Sorry?
But the committees,
Sorry.
board members must be on these committees, but the committees can also recruit non-board members. So, and that way they ensure that they have the right composition, but they also ensure that it isn't a committee that's 100% of just the board advising itself.
Right.
So there's also an opportunity for the board to get external attachments to help advise it.
Okay. So,
So
okay.
it's a mixture,
Okay.
typically.
So I'll stand by.
I'm just going to say, Carl was just reminding me that the World Council also supports and defines the audit committee.
As a part of the board.
For the audit committee, if I must say, in my credit union.
That's my question. Thanks.
In the past, when we look at audit committees, it's the same committee on a board. That's like the HR committee, the investment committee. It would have two board members, and they would have like the financial controller or the risk person. They will make up that committee. And I think that's what you are talking about at World Council. But it's nothing to do with an elected committee, like the supervisory, the credit, and the board.
In modern practice, those committees aren't just board members, management. They pull people from outside of the organization entirely.
Non-executive.
So that,
With our credit committees, because we have two boards, like the treasurer and somebody, and then you have a credit. Then you have a credit risk person, and now just recently, we're having somebody from the outside coming in on a contractual basis to work with that committee. So the credit unions, we are being compliant, we are trying, so, and you know, and it will work. So I know. Right, and that's what we are working on.
Have it formalized in
Because if you would
legislation.
note that we are now having a credit union training institute where all of these things will be put into place, and we'll have it across the board. So we are working towards all of that.
That is good to
Because we
hear,
don't want to
Madam
lose
President.
another credit union.
Thank you. Thank you, Mr. Neely and Ms. Delaveau. Any further questions from the floor?
It's just a comment that the nomination committee needs to remain independent of the board. Some of the comments, I think, would have been expressed by members in the room. We note that you're proposing having directors to serve on a number of committees. Are you mindful, again, of that the board members are paid a stipend, which is not a paid position? So I don't know if that's something you would respond to, or if it's just a statement, but it's just saying that, yeah, it's more so of a, just if you're aware that it's not,
Not even a stipend?
yeah, it does align with what he was saying.
Is a stipend or there's?
They are paid a stipend,
are.
but it's not a paid position.
Okay, just like
not
any
a
other
paid-
board, I
yeah.
imagine, Governor, they typically
no,
obtain.
it's
stipend.
recognized, and maybe the point that they're getting at is that
not
this is not a competitive compensation. That's understood. So we anticipate that, you know, cooperatives will continue to benefit from the volunteer spirit of people who assist them. You know, one of the things that we also need to discuss with the sector is the flexibility in terms of how you recruit persons who assist you. And I think in those cases, you need not be constrained just to the membership. If you can co-opt other people to sit along with the board and committees and provide input, and the volunteer spirit remains strong, then we should have a conversation as to how you can get access to those individuals.
So another comment is that the consultation paper stated that the supervisory committee will remain unchanged. However, section 13 of the draft bill states that the word supervisory would be deleted and substituted by the word audit.
Okay, that must have been an oversight because it was a very late change in the game. So we will correct that. Thank you for highlighting that for us.
Another,
Just to be clear, so you wouldn't be deleting supervisory?
No. Supervisory committee will remain as a separate committee from the audit committee.
okay, just highlighting that the supervisory committee is considered a watchdog and is independently appointed. So they're noting that if you're not on the board, you can still call a meeting. If you remove the independence, you may remove the independence if you have a member of a board on that committee.
On the supervisory committee?
Yeah.
Oh, that's not the case. The composition will remain as is. Yes, supervisory committee, the composition will remain as is.
What I was saying was that a lot of persons, they don't realize that the supervisory committee, they have a lot of power. If you look, I know you were saying that they just read and do all of this, but if they do what they're supposed to be doing, they are very powerful. They could remove boards. They could call special call meetings to the AGM because they are elected body. So that's what we have to look at, is strengthening and like across the board for our supervisory committee members.
Will there be an ability to have board members who are not members of the credit union or have minimal holdings to allow for more diverse boards? Also, some supervisory committees by election can consist of members only from one particular island, whether it's New Providence or Freeport. Oh, that's posed as a question, but are there any provisions on the background or diversity of supervisory or audit committee members?
I would say that the industry would be encouraged to advocate, for more diversity in terms of how they staff these bodies. Definitely, we're very open to how that would look.
Co-op persons serve as consultants who are and have been utilized by credit unions. Why change this? Co-op persons serve as consultants who are and have been utilized by credit unions. Why change this? Is that this isn't being changed?
Yeah, I don't think we're attempting to change anything. This is just working to, as I mentioned before, add and enhance.
I don't know if anyone else has any questions for us. If you don't at this time.
I just wanted to comment
Sorry?
on that last point that was raised. Just to say that the proposed amendments are, as you stated earlier during your presentation, to strengthen the sector. So it's not intended to have any adverse implications on the sector. And just as I mentioned earlier, credit unions operate similar to banks. And so our role as the regulator is to ensure safety and soundness. And depositors place funds with the credit union sector. So they would want to be comfortable knowing that we have strengthened our supervision of the sector. So that's the aim.
Protection of
Depositors' funds, yeah, protection of depositors' funds. Thanks, Carl. That's it for me.
Okay, so the final point from the Teachers and Salaried Workers Co-operative Union, if the supervisory committee remains unchanged, why remove them from the act?
Okay, so I believe we clarified that already, but just in case that person is late joining us, we do not intend to disturb supervisory committees, the provisions relating to those at all. And the only, I think it was section or clause 13 that may have suggested that we were removing the term or replacing it. That is an error, and we intend to correct that.
Another question coming in. Are you aware that from an international perspective, cooperations are supposed to be tax exempt? So why the move to charge VAT?
It's not all businesses in the Bahamas are exempt from profit tax. So if that's what the individual is referring to, then that's universally the case. In the case of the value-added tax, it's really dealing with the instances in which they are encountering that in their inputs to the operation, and making certain that there's clarity in terms of how that is administered. I think there's still some aspects of government taxes where in transactions specific to the operations of credit unions that the taxes are still not applicable. So those cases do not go away. It's more a reference to value-added tax in the context where these entities are procuring goods and services from the same providers as the general public.
I just mentioned that was something that we fought for, having VAT removed from our members, not necessarily no place else.
But is that in relation to the fees and charges that you assess?
Yeah, but the only thing we pay VAT on now is our on our investment properties, nothing else. And so I don't see how that should be taken back from us.
We're looking at, I mean, there's more clarity that can be brought to this, but the way the provisions are written in the Cooperative Credit Union Act, and they need to be expressed, I think, cleaner, because so that you remove any confusion as to whether if you're purchasing the office supplies or you're paying your utilities bill, and or some of those other instances, whether the same applies. You're referring to value-added tax in the context of real estate. That's basically replacing what used to be the stamp tax. So I can understand if that provision was intentionally kept, and those are examples where I think the clarity, could be better, and some of the clarity might even be expressed in the Value-Added Tax Act to help as well.
I think it's just on, everything that's the members, the products and services that we get.
Okay, I believe that brings us to the conclusion of this segment. Thank you once again for those tuned in virtually and to all of you in present. But before I'm concluding my segment, and I'm inviting our Deputy Inspector to come with closing remarks. But I'd also like to remind you that the consultation period is open until the 31st of October. So you are welcome to submit any further questions or comments that you may have during that period. Thank you.
So as we wrap up the day, it's worth mentioning some of the key highlights of what was shared today on the proposed legislative reforms without hopefully not belaboring the session too much. From our morning session, we were made aware of the introduction and intended rollout of agency banking to aid in central banks' financial inclusion initiatives, allowing banks to appoint agents, but having them remain accountable and liable to ensure consumer protection. We also noted updates proposed to the Central Bank Act, allowing for two-tier penalty system, notably introducing the small service financial institution definition, which in essence allows for some measure of proportionality in the penalty framework. We will also see some clarification related to enforcement language within the Act, and of significance is the proposal of separate penalties for late and erroneous filings to introduce a flat penalty charge for erroneous filing rather than the per diem charge. This, I know, is a welcome change for some entities. We would also have been advised of the various changes proposed to the protection of depositors AML regulations, bringing the credit unions under the ambit of the broader protection framework and continuing to foster strong customer and consumer protection. In relation to payment service providers, it is proposed that MTBs will now be governed under the Payment Regulatory Framework rather than under the Banks and Trust Companies Regulation Act. Our legal colleagues also spoke in some detail about additional enhancements to the resolution framework, in particular noting the inclusion of the credit union sector in the resolution regime. Also highlighted were the proposed reforms to strengthen the Deposit Insurance Corporation's powers to support resolution actions and facilitate faster and smoother payout processes should the need arise. In this afternoon session, we focused primarily on the credit union sector and the proposed amendments primarily addressing enhancing the supervisory framework around credit unions and the sector's governance frameworks. As indicated throughout the presentations today, we do value the comments to the proposed reforms, and we look forward to your feedback by October 31st. As was pointed out, and as is customary, we expect to publish the comments and queries received along with central bank responses. It is important to note that when making proposals for legislative amendments or reform, the central bank does not take such actions lightly. We do so after much thought and in the best interest of the financial industry within the Bahamas, in keeping with our mandate, with one of our mandates, to ensure a safe, sound, and compliant financial system. At the same time, taking into account consultation and feedback received. So, we do thank you for partnering with us in this undertaking. Specifically, we thank you for attending today and for your participation. And we look forward to hearing back from you very soon. I thank you.
Oh.